Good afternoon, Quasar Markets Live. We've got such a great session here for you. I've got world famous Dr. Alan Ellman straight back from Vegas. How are you doing today, Miss Dr. Ellman?
Well, I'm on Quasar Market Live. How much better can it get, Howard?
Absolutely, absolutely. I know you were just speaking at a big conference out in Las Vegas, so we're so happy you were able to join us. I will say that your IBIT has been a big viewed video, our biggest so far with you. I didn't mention that before we came on,
Okay.
and I've actually re-aired it a couple of times, so people are excited. I hope that you got the same kind of reaction in Las Vegas from your demonstrations and
Oh yeah,
presenting.
the feedback was great, and the crowds were large, and it was a great experience, as I told you before, including visiting the Sphere, which is a must for any of your viewers who end up going to Las Vegas.
I'm with you
Absolutely.
there. I've heard such great things. We were talking about it. I can't wait to get out there to do it. Well, let's get right into it. One of the things that I wanted to talk about, because I think sometimes, people either group educators or strategies into one of two groups. And I think that nobody really does it in one or the other. And what I'm saying there is fundamental analysis versus technical analysis. And I know that in a lot of ways, you have a lot of fundamental analysis that goes into your strategy, but you still use technical analysis for your entries, exits, and for other decisions that you make. Is that correct?
The technical analysis is critical to our option selling strategies. Back in the 1990s, when I started teaching myself these strategies, there were two schools of thought. One of them was fundamental analysis. That's all you need to know to establish your trades. Then there was the other one relating to technical analysis, which is the topic of our discussion today. And I remember thinking to myself back in the day, hey, why not use both? Isn't it better to incorporate both into our strategy than rather one or the other? So I kind of followed that pattern since the mid 90s, almost 30 years now, and it's worked very, very well for me over those 3 decades. But technical analysis, our topic today, is absolutely critical.
Yeah, it's funny that you say that because I have seen a melding of those minds more and more over the last few years, and you really have to. Right now, it's also tweet analysis, as I joke about, is so important, which falls into more of that fundamental analysis. But all it takes is a few more tariff tweets, and the market drops further, right?
Well, yeah, I mean, there are fundamental reasons, there are technical reasons why a stock or the market itself can decline, and we have to be aware of these. I mean, as investors of our own money, where we don't hand it over to somebody, we have to know the key fundamental and technical reasons why stocks move and why the market moves. So one is just not good enough.
Yeah, absolutely. And yeah, I call it the old one trick pony. You can't be a one trick pony in this market. You've got to be looking at it. And, I think it gets played down because people will say, oh, Warren Buffett, he doesn't believe in technical analysis. I don't agree with that at all. He just holds stocks for longer term investing more than he does day trading.
Yeah, well, of course, also now we're dealing with options, and
Yeah,
options are very short-term investments. So that
absolutely.
differs quite a bit from the buy and hold strategy of a Buffett, let's say. But yeah, for technical analysis, you really should be using it in two different ways. One, to determine which underlying securities you're going to base your options on, and
Right.
two, strike price selection. So
Absolutely.
we'll get into that in the discussion. But not only is technical analysis important, but it's important from two different perspectives. So
Yeah, I couldn't agree more. Absolutely.
so when we BCI screens stocks and ETFs for our members, we have a three-pronged approach, and this kind of leads into your beginning remarks here. Which underlying securities should we be using for options selling or really any options trading? And we have a three-pronged approach. So one of them is fundamental analysis, as you alluded to earlier. Now, why is that so important? Because that's actually my first step. My first step is to identify elite performing underlying securities. The
Right.
reason it's so important is because the big boys, the institutional investors, just love securities and companies that are elite performers from a fundamental perspective, sales and
Yep.
earnings growth. So you know what? If those guys like fundamentally sound companies, then so do I, because they move probably 70% or more of the market, more than
Absolutely.
retail investors like you and me, Howard. So
Now, I'd also point out that you compare a lot your techniques with real estate, right? With owning real estate. And where do you want to buy real estate? On, everybody paid extra to get on Wall Street or to get on or to buy Park Avenue, right?
right, right. So the quality of the underlying security is critical, because when we sell an option, the first thing that happens is cash is brought into our account.
Yeah.
But we have a liability, and we have a contractual obligation to sell those shares. So our enemy is share price decline. So if we select securities that are elite performers from a fundamental perspective, and from a technical perspective, and from common sense perspectives, and I'll get to that in a second, we're off to a good start, because those stocks, although yes, they can fall in price, are less likely to fall in price than those that fall short of those requirements. So yeah, fundamental, technical, which we'll talk about. And just briefly, let me say, common sense principles that don't fall into the other two categories can be avoiding an earnings report, cash allocation, diversification, minimum trading volume, things along those lines. So those are the three prongs of the screening we do. And but technical analysis is the topic you wanted to discuss today. I'm happy to do it. And we'll discuss the 4 indicators that I use for the last now 30 years successfully with
Okay.
these strategies. And then I'll show you what a bullish price chart would look like, one that's mixed and one that's bearish.
Absolutely. I love it. Of course, only if it moves for me.
Okay, so we just alluded to that a few seconds ago. We start with fundamental analysis, then we go to the common sense principles that I alluded to, and then finally reading a price chart, because we want to know all about trend and momentum regarding the price action of this underlying security. Is this a good stock to buy or write a put option today? It may
Right.
be yes today, it may be no 2 months from now. That's why we're constantly updating our technical analysis for our premium members.
Absolutely.
So here are the 4 indicators that I use, and I always tell my members, look, these are the ones I've been using for 30 years now. They've worked extremely well for me over those 3 decades. But you may have one that you really like, and that's okay. You're not married to the ones that I use, but I'm happy to share with you the ones that I've been using for so long. So, but as long as they contain trend identification, momentum, and they should always be a volume component to justify or confirm the other indicators, and maybe look for something like negative volume divergence. And what that means is, let's say we have a chart pattern with a stock that's heading to the moon. It's like on a 45-degree angle. Beautiful chart. But then let's say, hypothetically, that if we take a look at the volume, we see the volume is declining. It's heading in the opposite direction. Well, that's a red flag. So if we see that negative volume divergence on that rocket ship heading to the moon, we may say, you know what? I have a stock that is not showing negative volume divergence, that's just as good as the other one in every other way. I'm going to go with the other one. Or you might say, this is really the best of what I have. Maybe I'll write an in the money call to give myself a little extra protection to the downside. So it can influence technical patterns, can influence not only should I use that stock, but also what kind of strike, a more aggressive strike or a more defensive strike. So
And I
here are
think
the 4. I'm sorry, Howard, go
I
ahead.
was just going to say, I think it's important what you said is, if certain people charts hit their eyes certain ways, and it's more important to make sure that you're catching the same thing where you're looking for trend, momentum, and volume, and especially for volume divergence, more so than the actual individual indicators, right? Some people like SMAs versus EMAs. EMAs is going to give you more a more measure of momentum, especially momentum and trend together. I've seen people, I like RSI personally over just a scholastic oscillator, but it gives me the same momentum. So there are different ones you can use, but I think the key here is to make sure that you are covering all three of these components would be my takeaway.
Yes, you should cover all three components. And, you brought up several points that I'd like to address because they're so important. First thing you mentioned was simple moving averages, SMAs. And those are the ones that most investors are familiar with because most investors start off just buying and selling stock. So if you're buying a stock, let's say figuring to hold it for a longer or long term, then you're probably going to use the 50-day and 200-day simple moving averages because they're kind of longer term type of investments. But when you're selling options the way that I do, covered call writing and cash secured puts, these are basically short-term options, especially if you're doing it right, they're short-term options.
Absolutely.
I know a lot of people will sell a covered call like a decade out or something.
Not
And
understand why
that's
it
a
didn't pay
mistake
off.
from so many different perspectives, but
Yeah.
maybe that's a topic for another day. But yeah, so if you're doing it right, you're selling weeklies, maybe monthlies. So we're going to be using exponential moving averages. And what those do is they put more weight to the more recent prices. So you'll get a quicker change in the trend line using 20-day and 100-day exponential moving averages than you will for, let's say, just buying and selling stock, where you're using 50 and 200-day simple moving averages. So there's your trend indicator, exponential moving averages, 20-day and 100-day.
Yeah, absolutely. I actually use a super guppy, which uses a bunch of EMAs to give me a visual look. It looks a little bit like almost like a wave for it. So I'm with you there.
Yeah, I mean, there are so many really good indicators, and that's why when I show our members or when I'm doing presentations, I always say, as long as they include trend and momentum and volume, we're good to go. Doesn't have to be the ones that I use. Now, if we can go back for a second to the last slide, I just want to list the other indicators that I use. And, the second one that I use is the MACD histogram. And we don't really need to get into the weeds of the mathematics of the MACD histogram, but what it does is it measures both trend and momentum. And when you look at it on a price chart, it's basically a blue bar. So let me tell you how easy it is to interpret MACD histogram. If those blue bars are ascending, that's good. If they're descending, bad. Now, if it's above zero, good. Below zero, bad. Now, you can almost say the same thing for the exponential moving averages. We'll show you on the screenshots coming up, but we would like to see those ascending, those exponential moving averages, and we would like to see the shorter term 20-day EMA above the 100-day EMA because we want the more recent prices to be higher than the older prices. So if you can see if a line's going up or down, or if it's above or below zero, hey, you could read a price chart. Now, eventually,
people do get themselves psyched out sometimes on price charts where it isn't as difficult as some experts would make it out to seem, especially if you stick to, I say less is more sometimes. Sticking to 3, 4, 5 indicators for a lot of people is more than enough.
Oh, yeah. Absolutely right. And that's why I basically use 4. Now, if you set up the very same parameters for every stock you're evaluating, when you put in that ticker symbol and with the parameters that you use all the time, you'll be able to identify that chart as bullish, neutral, or bearish within 3 seconds. That's how long it's going to take. Now, when you're first starting out, it may take you a few dozen slides or examples of charts to get comfortable with it, because at the beginning it's a little intimidating and you see these lines and waves going all over the place. What the heck is going on here? But then after a while, you're seeing the same thing over and over again, and you'll, like that, be able to identify it. So, I want your viewers to know that although if you've never done technical analysis or reading a price chart before, it's no big deal, and it won't take you long at all to become very, very comfortable with it.
Absolutely.
So the MACD histogram, trend and momentum, it's that blue bar. You'll see it. The stochastic oscillator is another momentum indicator, and you'll see a black line. Is it going up? Good. Is it going down? Bad. And there are other percentiles. If it moves above the 20, that's a bullish signal. If it moves below the 80th percentile, for right now, let's just say ascending good, descending bad. And then volume, if you see robust volume on these indicators, you know that's pretty much confirming those indicators. But if it's, let's say, a holiday and there's very light volume and the moving average goes from bullish to bearish, I would put less weight in it because volume is light. And again, if it's the same or better than it has been historically, then you know that you could take to the bank those indicators are meaningful.
Would you sometimes look for, if say volume was low on an individual stock, and just for confirmation, would you maybe look at what the volume's looking like on maybe the SPY, QQQ, or something like that, just to see if it is relevant, to that day?
Well, no, in other words, if the volume on a particular security is robust, then I would take those technical indicators as meaningful, even if the overall volume on a benchmark is not.
Okay, I get it now. Okay.
So this is an example of a bullish price chart. I hope your viewers can see it. Is there any way we can make it larger? Maybe
let me see what I can do there. That I don't know if I can, because we're at the whims of PowerPoint here. Hold it one second.
If not, I could make my point.
Doesn't look like there is a way to do that, unfortunately.
Okay, let's go back to the previous slide, the bullish price chart on Dorian LPG Limited, listed on the New York Stock Exchange under the ticker symbol LPG. So let's go through. Oh, that's great. Good job, Howard. Nice.
I figured it out.
Yeah. Okay. So the top is the exponential moving averages. Now, where you see the blue arrow on the top, that's the 20-day exponential moving average. It's the shorter term moving average. Now, where you see that red arrow on the top, that's the 100-day exponential moving average. Now, because the 20-day is shorter term, we always would like to see that above the 100-day longer term. And you could see clearly that it is. We'd also like to see these lines ascending. Clearly they are. And finally, the price bars, or if you like candlesticks, we like to see those at or above the 20-day exponential moving average, which you could see definitely they are. So if you just said, what do you have to say about the trend identifying exponential moving average indicator? Absolutely bullish signal. Now let's move down to the MACD histogram. Remember, I told you before that those will be in the form of blue bars, which you could see all the way to the right where the red arrow is in the middle of the chart. And you could see clearly that those are above zero and they are ascending. So you could say that at this point in time, the MACD histogram, which you recall is a trend and momentum identifying indicator, bullish signal. So we're 2 for 2 so far. Now we move down to the stochastic indicator, oscillator rather, which is that black line, the long red arrow on the lower third of the graph. And you could see that it had gone down, but recently with that small red arrow was all the way to the right, it's been going up for the last couple of weeks. So it's showing a positive bullish signal regarding the stochastic oscillator. So now, Howard, we are 3 for 3. Now, is volume confirming this? Well, in the green oval there, yes, it is. The volume bars are pretty much historically the way they've been over the last 6 months. We're not experiencing negative volume divergence. So I'm telling you, within 3 seconds, if you do the same kind of technical chart setup, it doesn't have to be the one I do, but the one that you're comfortable doing, 3 seconds, boom, bullish price chart.
Yep, absolutely. Let's look at a mixed price chart.
Mixed one, the same stock. And you could see that, let's start on the top with the exponential moving averages. Now, you could see that we still have the 20-day above the 100-day EMA, so that's good. But you could see where that green arrow is all the way on the top right, that the
whoops, sorry about that. There you go.
You could see that the price bars are starting to move down. So although it's still above the 20-day EMA, was saying, let's see what's doing with the other indicators,
Yeah,
because
because it
that's
definitely looks like it wants to retest it for sure, right?
yeah, it's coming down. Is it going to bounce back, or what's going on with the other indicators? So now let's look at the MACD histogram. Now it's a little hard to tell, but where that green arrow is in the middle, that is barely above zero. And you could see that those blue bars are beginning to descend in the
Yeah.
same way that the 20-day, the price bars are beginning to move down on the top.
Turnover
So
also,
we
yeah.
got two bullish signals, but both of them beginning to show perhaps signs of weakness. Now let's look at the stochastic oscillator number 3, and you could see that that's beginning in the last week or so, that's beginning to show a bearish signal. It's beginning to decline.
Yep.
And it dropped below the 80th percentile, which when you get into a little more detail, that is a bearish signal. When it goes from above 80 to below 80, that's a bearish signal. So we got barely aggressive, barely bullish, and we have a beginning of a bearish signal with the stochastic oscillator. And are these signals true? Well, you could see the volume is definitely robust. So yes, what
Yep.
would we call this? As I have on the top, a mixed price chart. So what the heck does that mean? Well, it means the following. If we have another stock and everything is the same from a fundamental perspective, from a common sense perspective, but one stock has a bullish price chart and the other one has this price chart, I'd go with the other one.
Right. Makes sense.
Also, if we decide to go with this one, then I'm more likely to use an in the money call strike to give myself the additional downside protection given by the intrinsic value component of that call option. Now, if I'm selling 5 contracts, Howard, that doesn't mean all 5 are going to be in the money. I might go 3 in the money, 2 out of the money. I may make a mix. But what I'm saying is knowing how to read a technical chart helps us not only in selection of the underlying security, but also selection of the strike price.
Right, managing it from there. That's what I was going to ask. I was going to say, if you had walked in and the first chart was what got you into the trade, and then you were looking maybe the next week at the one that you've put in front of us, that I was going to ask, and you said it. You would be looking more at in the money call strikes versus out of the money call strikes to give yourself a little bit more breathing room, so to speak, within your trade strategy, right?
That's a good point. I might have gone out of the money in week 1, and then the chart is beginning to turn a little bit. Then I might thought, you know what? Now I'm going to go in the money to give myself that protection. And that's what most people don't do. Most people don't do that.
Yeah, well, that's what I love about your strategy. I mean, I don't want to get your head too big because I've said it so many times, but you're one of the few people I've seen who does take all of these components, into account, and where you just didn't decide, I have a system and that's the system. You look at your system continuously. You're always tweaking it. You're always looking back to say, what could I do more? And as you know, what brought me to you was really your book on exit strategies and what you do once you're in a trade, as opposed to just how to get into a trade. So not to
every little thing you do to enhance your strategy, the way you manage your trades, is going to make your returns go higher and higher and higher. It's not a waste of time to do these things.
No, I agree fully. I do it all the time. Now, I didn't always. So now we're looking at a bearish chart, we think.
Yeah.
I'm not ready to commit yet until I hear all the components.
Yeah, right. So here we have a chart that shows it's a different underlying. It's Everest Group Limited, listed on the New York Stock Exchange, EG. Now you could see on the top could you make it bigger here, Howard?
Oh yeah, absolutely.
Yeah.
Sorry about that.
So you could see on the very top, you could see that the price bars have now dropped underneath that blue line, the 20-day exponential moving average. So this is a big bearish signal right there. It doesn't mean that this stock is going to continue to plummet, but it's something that if you are not already in this stock, I would pass at this time. Now, if you go down to the MACD histogram, those blue bars, they have now dropped below the 0 line. where that middle purple arrow is in there. They've
Yep.
now gone bearish. And if you look at the stochastic oscillator, the bottom purple arrow, that
Yep.
also has been descending and dropped below the 20th percentile. So we got three bearish signals, and they are confirmed by robust volume. So if the volume was very weak, I wouldn't be as concerned, although I probably wouldn't use this chart anyway. But
Right.
it's robust volume, three bearish signals, trend and momentum. I'm passing on Everest at this point in time.
I can see why. Absolutely. I agree. I don't have any questions that you nailed it. It's one of those ones where there isn't any, contrary signals at all.
Well, because we also started with bullish and
Right.
mixed, so there's not much to say. When everything turns negative, it's time to get out of Dodge.
Absolutely.
So
Let's
I mean
bring it
that's
all back in.
basically it. Technical analysis, Howard, should not be your only criteria for stock selection. No,
Right.
but it should definitely be one of the three-pronged approaches to stock screening for options. And also, it gives you the advantage not only of stock selection, but also of what strike price. So it helps guide us into what strike price to use based on the technical chart.
Yep. Yeah, I couldn't agree more. Like you said, too. Um, you know, if there's a mixed price chart, you will get in there, but you will do it with the idea of having an in the money call to protect more to the downside. So you're tailoring your strategy to the market in front of you, not just playing the hand. You got to play the hand you're dealt, right?
Right. I mean, what again, there's no guarantee when you go into the trade using in the money and the stock turns around and starts heading up north. Uh, I never say to myself, "Oh, geez, I was wrong. I should have gone out of the money." No, you're not wrong. With the information that you had at that point in time, you did absolutely the right thing, and you know that it's never going to work out 100% of the time. Just like buying a stock. I mean, you've been in that field and area for a long time, Howard. You know that a lot of times you'll buy a stock based on the information you have at that point in time. And then things will change. Does that mean you were wrong for buying it? It does not. It just means that things changed, and now you've got to mitigate and kind of readjust your game plan.
That is so important. I'm glad you brought it up because it is something that we learn and that is important is trading isn't 1,000% probability. Anybody that tells you they're always right, that they never miss, that this works 100% of the time, that is a red flag among all red flags, right? Is because all we're doing is we're using the best information we have and using historical precedent as a basis to make a trade. That's what technical analysis basically is. It looks at the past to provide you the psychology of the market, right? And that's, what we're looking for is to have the psychology of the market in a visual interpretation.
And also by throwing in momentum indicators, you're kind of taking a little peek into the future because
Absolutely.
of the momentum. It's not guaranteed, but it is a little peek. And I want that advantage. I
Yeah.
want to have that advantage of those momentum indicators.
Though I did have one question. I'm going to go back a little bit here because I was going to ask you one thing and it kind of played out. Do you ever get nervous on your stochastic indicator of being too high when you get up like 94? For me, at that point, that one would have been almost a mixed signal because at 94, I think it's going to turn over.
So basically, is it overbought? Is
Right.
what you're
Yeah.
asking?
So I'm looking
Is
here
it
at
an
this.
overbought? So this is something that I actually did study over long periods of time back in the day when I started developing this strategy. And the answer to your question is I've actually seen stochastic oscillators above the 80th percentile for months and months and months. And because we have the advantage of doing weekly and monthly positions, not long term, weekly
Right.
and monthly positions, we can actually reevaluate our bullish or bearish assumptions 12 times a year, 52 times a year.
Right.
So if we see that stochastic oscillator, as we did in one of the slides, start to indicate like a bearish turn, we can
Yep.
reevaluate for the next upcoming cycle. It's not like we're stuck with it. So no, I'm not afraid if it's in the overbought or above the 80th percentile at all. Now, if I
And that's
see a
interesting, because
downturn,
I don't get nervous because I come from the world of Bitcoin where it can stay at, it goes to 90 and can sit there and just take off, from it the same way it can go to 12 and still have downside. So I'm used to that world. I wasn't sure. So that's good to know that translates over to your strategy a lot too.
absolutely, you will see a lot of securities that remain above that 80th percentile for the stochastic oscillator for months. And
Okay.
if you were afraid of that and you got out of it, you would have missed out on a lot
Absolutely.
of money.
That's why I wanted to ask, because I would have been looking at that a little nervous for the overbought area because just that's the way that I was sort of trained. So that's good, good for it. And like I said, I use an RSI as opposed to the slow STO, so it might be a little bit different there too, and how that plays out. So. Well, thank you so much, Dr. Ellman. This was great. It gives people a view of what to look for. It also shows people, what the three charts, and you don't need everything to be, what I would also take as a takeaway from this is you don't necessarily need to have all four indicators just pointing straight sky high. There are different approaches to your strategy based upon what it is set up as, though, right?
That's a great evaluation of everything we talked about today. Is that mixed price charts shouldn't scare you, but should help guide you as to how to craft that particular trade.
I love it. We're going to end on that note because I do think that is the key takeaway from today. Thank you so much, like always, Dr. Ellman, and we will have you back